Drake has $10,000 sitting in a savings account. He's proud of it, and he should be. Saving $10,000 is genuinely hard. 10 years ago, Daniel had the same $10,000. He invested it instead. Same starting number. Two completely different accounts. By the end of this video, you'll see exactly what that one decision is worth. In real dollars, not vague advice. Plus, how to actually do it yourself, which account to use, how buying actually works, and the order it should happen in. Quick one before we get into this. If breaking down real numbers like this is useful, hit subscribe, new video every week. A high-yield savings account today typically pays somewhere around 4 to 5% a year. That's a genuinely good rate for a savings account. It's federally insured up to $250,000 per depositor per bank, and the money never drops in value. The stock market, measured by the S&P 500, has averaged around 10.5% a year in nominal terms since 1957, or roughly 7% a year once you adjust for inflation. That gap between 4.5% and 10.5% sounds small on paper. Over 10 years, it isn't. Drake isn't doing anything wrong by saving. He's just leaving a second, much bigger decision on the table, because safe and growing are two completely different jobs for two completely different accounts. One caveat worth naming up front, that 4 to 5% savings rate isn't fixed. High-yield savings rates move with the Federal Reserve's own rate decisions. The number in this video is a snapshot, not a permanent fact, which is one more reason it's worth checking the current rate before treating any of this as gospel. Here's the actual math. Using a standard compound interest calculator and no extra contributions, just the original $10,000, left alone for 10 years. At 4.5%, $10,000 in savings grows to somewhere in the neighborhood of $15,500 after a decade. At 10.5%, that same $10,000 grows to somewhere around $27,000. Same starting amount, same 10 years. A gap of roughly $11,000 to $12,000 created entirely by which account the money sat in. That gap doesn't build evenly. Compounding is backloaded, the growth in the earlier years is modest, and the bulk of the total gain shows up in the later years. Once the balance itself is large enough for even a small percentage to represent real money. The first few years of this 10-year stretch look unremarkable. The value of starting early shows up disproportionately at the end. Daniel didn't do anything complicated to get this. He didn't pick winning stocks or time the market. He bought a broad index fund, something that tracks the entire market instead of betting on one company, and left it alone. Index funds like this typically charge somewhere between 0.03 and 0.2% a year in fees, compared to 0.5% to 1.5% for actively managed funds. Over 10 years, that fee difference alone is worth paying attention to, since a fee is a guaranteed drag on the return regardless of what the market does that year. Here's the honest part of this video. That 10.5% average is exactly that, an average. Large company stocks as a group have historically lost money in about 1 out of every 3 years. Some years the market drops 10, 20, even 30%. The average only shows up if you actually stay invested through those years, not if you pull out the first time it drops. This is where most people who try investing after watching a video like this one actually lose money, not because investing doesn't work, but because they invest right before a rough year, panic, and sell at the bottom instead of waiting it out. The math from earlier assumes the money stays invested for all 10 years. It doesn't work if the money gets pulled out in year 3, because year 3 happened to be a bad one. Investors who stay in for long stretches, 15 years or more is the window commonly cited, have historically been rewarded with strong, positive returns despite the rough years along the way. The strategy only works if the money is money you genuinely won't need for a while, because the entire 10.5% figure is only earned by whoever is still holding the investment when the good years happen too. There's a separate, more extreme version of this risk worth naming. An individual company can fail entirely. If a company goes bankrupt, common stockholders are last in line behind bondholders and preferred stockholders, and can end up with nothing. This is exactly why the earlier example used a broad index fund instead of one company's stock. A fund spread across the entire market doesn't carry any single company's bankruptcy risk the same way a single stock does. The 10.5% figure this video keeps using assumes one specific thing invested entirely in stocks. Most people investing for a real goal, not just a video example, spread that money across a few different things instead, a practice called diversification. Bonds are essentially a loan. You lend money to the government or a company, and they pay you back with interest. U.S. Treasury bonds specifically are backed by the federal government and considered the safest widely available investment, split into T-bills under a year, Treasury notes from 2 to 10 years, and Treasury bonds from 20 to 30 years. Series 1 bonds, a type of Treasury bond, are inflation protected, though limited to $10,000 per person per year, and bought directly at treasurydirect.gov. A commonly used starting structure is called a three-fund portfolio: U.S. stocks, international stocks, and bonds, combined in one account. It won't outperform an all-stock portfolio in a strong year, but it also won't fall as hard in a bad one. Bond prices and interest rates also move in opposite directions from each other, which is part of why bonds smooth out a portfolio's swings rather than simply following the stock market at a smaller scale. How much of each depends mostly on time horizon. Someone 30 or more years from retirement can typically handle more stock exposure, since there's time to recover from a bad stretch. Someone closer to actually needing the money usually holds more bonds. Prioritizing stability over growth. This video's $10,000 example assumed investing it all on day one. In practice, most people don't have $10,000 sitting around to invest at once. They invest a smaller amount on a regular schedule instead, a strategy called dollar cost averaging. The mechanism is simple. Invest a fixed amount at regular intervals, regardless of what the price is doing that day. This is exactly how a 401k already works for most people, contributing the same amount every payday automatically, and it's the same principle applied to any other brokerage account. It doesn't guarantee a better return than investing a lump sum all at once, historically. Lump sum investing has actually outperformed dollar cost averaging more often than not, simply because markets rise more years than they fall. What dollar cost averaging actually does is reduce timing risk and make the whole process emotionally easier, since you're never staking a large amount on a single day's price. Long-term investors tend to benefit the most from this approach, precisely because it keeps them contributing through both the good years and the bad ones. All the math so far skips a real question. How does someone actually buy any of this? A discount broker lets you buy and sell shares for a lower commission, but you're generally choosing your own investments. A full-service broker charges more, but that higher cost pays for actual investment advice based on the firm's own research. Most modern brokers also allow fractional shares, meaning the minimum to get started is the cost of a partial share, not the full share price. A single share of a broad index fund can cost hundreds of dollars. A fractional share removes that as a barrier entirely. The broad index fund this video keeps referencing isn't one specific product. Common examples include the SPDR S&P 500 ETF, ticker SPY, Vanguard Total Market, ticker VT, and Fidelity's Zero Fund, which carries no expense ratio at all. One more mechanism worth knowing: a dividend reinvestment plan, or DRIP, automatically uses any dividend payments to buy more shares of the same investment instead of paying out cash. Another way the compounding from earlier keeps working quietly in the background without a manual decision each time. Everything in this video so far has been about the decision to invest at all. There's a second decision that changes the outcome almost as much: which type of account the money actually goes into. Tax-advantaged accounts, a 401k through an employer, or an individual retirement account you open yourself, offer real tax benefits that a regular brokerage account doesn't. For 2025, the 401k contribution limit is $23,500, $31,000 for anyone 50 or older. The IRA limit is $7,000, $8,000 for 50 and older. A regular taxable brokerage account, by contrast, is subject to long-term capital gains tax when you sell at a profit, 0, 15, or 20%, depending on your income. It also carries the wash sale rule. If you sell an investment at a loss and then buy the same or a nearly identical one back within 30 days, you can't claim that loss on your taxes. None of this changes the core math from earlier. Invested money still grows at roughly the same rate regardless of account type. What changes is how much of that growth you actually keep. For most people, the practical order is capture any available employer 401k match first, since that's an immediate return before the market even moves, then use an IRA and use a taxable brokerage account for anything beyond what those two allow. Everything in this video assumed the $10,000 was free to invest. For a lot of people, it isn't yet, and the order matters. High-interest credit card debt typically charges more than the 10.5% this video keeps using as the investing benchmark, which means paying it off is effectively a guaranteed return higher than the stock market's own long-term average. There's no investment in this video that reliably beats a debt that's actively charging you more than the market has ever historically returned. If that debt exists, it comes before any of the investing math from earlier. After that, the honest order is pay off high-interest debt first, build the emergency fund second, and only then start moving money into the invested side of this video's comparison. Skipping straight to investing while high-interest debt is still active usually means losing more to interest than you're gaining in the market. For anyone who wants the diversification from earlier without building it manually, target date funds are worth knowing about. They automatically diversify across the same kind of stock and bond mix, and automatically rebalance that mix over time as the target date gets closer, without requiring the investor to manage it by hand. This isn't a case for moving every dollar you own into the market tomorrow. Money you might need in the next few years, an emergency fund, a house down payment next year, belongs in that 4 to 5% savings account. Not exposed to a market that could be down 30% the 1 year you need to withdraw it. The actual decision is which $10,000 this is. Money with a job in the next 1 to 3 years stays safe. Money with no near-term job, money you genuinely won't touch for 10 plus years, is exactly the kind of money that's currently doing far less work sitting in savings than it could be doing invested, ideally inside whichever tax-advantaged account still has room this year. Drake doesn't have to move all $10,000 at once. Even starting with a fraction of it, invested and left alone, is the entire mechanism this video just walked through, just at a smaller scale. Concretely, this week looks like confirm any high-interest debt and emergency fund from earlier are already handled, open a brokerage account if one doesn't exist yet, choose a broad, low-fee index fund, and set up the first transfer, even a small one, using the fractional share and dollar cost averaging mechanics from earlier. Everything after that first transfer is just repetition and time. Same $10,000, 2 accounts, 1 decision. Roughly $15,500 in savings after 10 years. Roughly $27,000 invested historically, spread across a mix of stocks and bonds if you're diversifying, built up gradually if you're dollar cost averaging, bought through a broker with fractional shares if the full price is out of reach. Held in whichever account type actually keeps more of that growth, and only started once any high-interest debt is already handled. The real, uncomfortable years in between are the actual price of that difference, not a flaw in the plan. This video is for educational purposes only and is not personalized financial advice. Historical average returns are not a guarantee of future performance. The market can and does lose money in any given year. Fees, contribution limits, tax brackets, and account rules referenced in this video change over time and vary by provider and by individual circumstances. Verify current savings account rates, contribution limits, and tax rules. And run your own numbers with a compound interest calculator before making any decision. Next video, we're building a 2-account system that makes overspending almost impossible. Subscribe so you don't miss it. New videos every week on the personal finance topics school never covered.